In Erich Reimer. He's the president of Nueva Horizons and a contributor to Seeking Alpha. Welcome back to the show.
Great to be on.
Now, as we saw, China announced its plans in November to ease the limit on foreign ownership of financial services groups. What sort of progress have we seen since then?
And so since then, China has announced more specific timetables for when exactly the ownership limits would be raised, as well as established when the ownership limits would be phased out entirely. They've also announced that the levels of regulatory approval will be reduced from 2 levels to 1 level. And furthermore, they've also very importantly announced that intellectual property rights, which have been a long issue that financial services firms have been concerned about in China over proprietary trading programs, as well as financial services technology, those rights will be protected. And so while there have not been specific regulations reforms implemented as of yet, nonetheless, there have been more concrete details about exactly what will be happening and how it will be structured.
So which financial sectors and institutions in China have benefited the most from those changes?
And so essentially the reforms will affect nearly every single financial services industry in China, ranging from asset management to traditional deposit and lending banking businesses. This will affect even the insurance business as well as the broker-dealer business. And so essentially is a wide sweeping reform of the entire financial services system in China, which is why currently banks and asset management firms from across the world are beginning to look very closely at this very long-awaited move.
So, being that this is long-awaited, why now? Why does China believe that now is the right time to loosen these restrictions?
And so it's primarily a response to slowing growth in the Chinese financial services sector, which has lagged behind growth in the other sectors in China's economy. Furthermore, it is also because foreign direct investment as a market share of foreign banking in China has declined in recent years. And so I believe China wants to spur increased interest by foreign banks in the Chinese banking system. And so essentially these reforms have been long advocated for by the United States as well as European financial service institutions. And so by finally opening up China, essentially these banks can finally invest in the $33 trillion asset size Chinese market and finally be able to have more of a say in their business operations in China.
And especially given the size and the scope of China's market, let's look at the specific companies that are most likely to really try and take advantage and get in there to either enter or perhaps expand into the Chinese market.
And so there's a variety of firms that are currently looking at expanding into the Chinese market. These include publicly announced JP Morgan, UBS, Morgan Stanley. And so I think that while these initial companies have announced they are interested in the Chinese market, I think if these companies show that they are making money and able to properly invest in China, able to gain profits from them, as evidenced by quarterly earnings and whatnot, I think this will spur greater interest on a broader level by financial institutions in China. And so we might, if it goes well for these initial institutions, I think we may see more companies interested as well.
And help us understand what this means for these Chinese companies or institutions that may end up being majority owned by foreign investors. How do they benefit?
And so essentially what happens when a foreign company will be able to directly control their investment in China is that they'll be able to basically establish corporate governance controls and et cetera, while previously firms that were invested in China that had minority stakes could not really leverage their ownership stake of, say, 10 to 25% into an actual say in the company's governance. And so by now being able to more firmly establish how the business is run, not only will be able to better leverage their brand, leverage their products, but also be able to this will also increase, I think, financial services institutions' interest in investing in China because now they will have a greater control over their assets. And as for the regular Chinese consumer and Chinese companies, I think this will be of a great benefit as well because now a lot of Chinese consumers will gain access to increased financial products, increased opportunities to bank with global banks. And furthermore, I think as some Chinese officials have discussed, the current Chinese banking system is in need of some innovation. And I think this will definitely spur it because by increasing competition, consumers will see lower costs, see greater availability, see greater innovation. And so I think on a broader level, this is beneficial to China, to the US, to Europe, to everybody.
And Eric, can we expect to see reciprocity with perhaps other countries feeling more encouraged to give China greater access to their financial sectors?
I mean, certainly reciprocity in free trade is an important factor. After all, if one country is not operating by the same rules, that definitely makes the benefits of free trade through competition, through increased, through lower costs and et cetera, not materialize. And so I think that these rules finally level the playing field for a lot of foreign investors in China. And I think certainly it will hopefully bring increased global competition and hopefully allow companies to, both Chinese companies and U.S. companies, to compete globally, as well as European companies too.